well, not really eventful week, but a week where we've been waiting and waiting and waiting for Jerome Powell and what he will say at his Jackson Hole speech later on today. And having heard from a few Fed speakers overnight, I don't think we're going to get anything that we didn't know already. So we're kind of in a holding pattern, which unfortunately I think is going to go and extend beyond this week, but well into next week and probably the week after that. And I'll explain why. Today, I'll have a look at some of the market pricing about the Fed and why you shouldn't want to go and cheer on too many rate cuts coming through, because potentially that would be a very bad time for financial markets. I'll have a look at what Powell may go and say, also have a look at some of the other daily and weekly charts involving currencies and also some equity indices, and a very, very brief look at NVIDIA as well, considering it will be reporting earnings at the on Wednesday after close next week. So without any ado, let's go get straight to it. And I'll go and get up on the screen right now a quick look at the Fed funds futures curve here. Now, apologies for those who saw my video yesterday, but I'm going to go and rehash some of what I said there. So basically, this is the curve between June of this year and June of next year. And basically, what you're looking at there is the amount of cuts in basis points that are being priced in by the market. So in this red zone here, you've got less than 5 cuts. You're probably going to describe that as being high for longer territory. This green zone is between 5 and 8 cuts after June next year. I call that like the temperate, nice zone. And then below here in this blue zone, that's a zone that we don't want to be part of. And I'll get to that in a reason why. So just to go and explain where we are at the moment. So markets with 176.5 basis points currently priced in, give or take, that's around about 8 cuts that have been priced in by June next year. So there's only 7 meetings that the Fed will go and hold until that point. So at the moment, the market is still flirting with the idea that potentially we'll have a 50 at some point and then a cut at every other meeting, which to me is bordering on getting to the territory where you describe it as being a hard landing. We're not there yet, but certainly at this point in time, I think for risk assets to really go and have a solid time, what we would like to go and see is for the markets to actually go and curtail the amount of rate cuts that they have currently priced in. So this zone is going to be a really nice zone for risk. You'd like to go and see a softer US dollar. You would also probably imply that we'll have a soft economic landing, policy returning to neutral levels. So no great dramatic rush to go and cut, which again should be good for corporate earnings and for economic activity more broadly. And in particular, it should be good for risk assets and cyclical assets, probably at the expense of defensive. Now, if we're going to see a repeat of what happened at the start of this year and the market having to go and curtail a lot of those very, very dovish bets, if we start getting back to this zone, this higher for longer zone, this to me is not terrible for risk. But what it points to is higher rates. It points to a stronger US dollar. And unless it's a stagflationary environment, it shouldn't be really problematic because you're still having the Fed go and cut, but just cut in a very, very gradual and measured manner, which to me is going to go and be okay, but it probably will make it struggle to go and get multiple expansion when you talk to the equity universe and things along those lines. So to me, like that's not a horrible zone. But this blue zone down here, and I've tried to go and depict it as being ice cold, this is where it becomes problematic because if you start talking about doing more than 8 cuts by June of next year, that is undeniably going to be a hard economic landing. It's going to imply that the Fed is going to have to deliver multiple supersized cuts, and I'm talking about 50s and maybe even more than that, depending on what happens. Also points to carry trade unwind. So we saw what happened at the start of this month with the Japanese yen and how aggressively that unwound. That would be another example of that. Risk assets in general would really, really struggle. And the US dollar, despite having more cuts priced into the curve, would probably go and benefit. But more so, you'd likely go and see the Japanese yen and the Swiss franc at this point in time. So it's be careful what you wish for. I understand that markets enjoy to go and see rate cuts and you want to see economic activity go and bottom out and then start to reaccelerate. But do not go and get excited about the prospect of 8 or more cuts over the next little period. To me, that would be really problematic moving forward. Let's go and have a quick chat about Jerome Powell tonight. So last night, I'm sure those of you who were tuning in, there was 3 Fed speakers that came out, Schmidt, Harker, and Collins from the Fed. And all with a really uniform type of message talking about calibrated cuts, being data dependent, and certainly not giving off the impression that they were rushing to go and slap on a 50 basis point cut to go and start off the easing cycle. Very, very data dependent. And that was the real message that came across, that not panicking, they're in a good spot, they're not behind the curve. There's, hold your when it comes to the potential. We'll go and see the need to go 20 basis point cuts. So that's by design. I'd be really surprised if the Fed hasn't gone and got a gaggle together and talked about potentially that this is how the messaging is going to be. And the three Fed speakers that came out overnight have softened the market up. So we've seen that short end US interest rates have pushed higher. The US dollar has sparked a little bit of a reversal taking place. I'd be really, really stunned if Jerome Powell came out and either did what he did at Jackson Hole 2 years ago and was very, very hawkish, or delivered a very, very dovish outcome at this particular meeting. I really expect that what we'll see is a continuation of the message that we heard overnight, that he'll discuss rate cuts. He even discussed them at the end of the FOMC meeting earlier this month. So I really question what else he can go and add beyond just saying that he's data dependent. And luckily, there's a lot of data coming up in the not too distant future. However, there's only going to be a real select few that are going to be really important. And unfortunately, none of them are going to arrive in the not too distant future. So tonight, I'd expect that we won't go and see any great deviation when it comes to Fed pricing. Is that going to go and be detrimental to risk? Well, maybe we'll see short end rates go and sell off a little bit, yield slightly higher, but nothing really problematic at this point in time. The Fed, like us, are data dependent in nature. On that topic, let's have a look what's coming up on the US data calendar. And look, it is a fairly busy week coming up next week. Let me get to the details here. So having a look across here, for a long period of time, we had to become really, really attuned to inflation prints. That was what really, really mattered when it came to market movements. But that's definitely shifted over the past month. And now it is much more about activity indicators moving forward. Now, when you look down this list, durable goods orders is on that particular list, something that potentially could go and move markets. But there's not a lot of top tier data. House prices, that's not going to go and really move the dial. More soft surveys, Richmond Fed Manufacturing Index, Services Index, etc. Same on the Dallas side. There's a couple of Treasury note auctions out as well that I'm going to discuss in a brief moment. But looking through here, there's not a lot to go and hang your hat on, which is unfortunate. Jobless claims we saw last night, a small increase that came through, but no sign that there's this dramatic weakening in the labor market yet, at least in that data point, to go and suggest that things are really starting to roll over. We get the second estimate of US GDP as well. Doesn't typically go and deviate too far from the initial, but just remember, this one has a lot more information contained in it. The advanced GDP print that comes out is based largely around assumptions and modeling that's done. So this is going to have more meat on the bones and more actual economic data. So you can sometimes get like a big deviation, but more often than not, it's a pretty good guide, that first one that we received there. So you can see here, 2.8% seasonally adjusted annualized rate is expected. And when you talk about other things as well, you can't help but this particular release here, the core PCE deflator. We know it's the Fed's preferred inflation measure. Also income and spending data as well. Now, we already have the CPI and the PPI out for July. So we have a really, really strong understanding of what to particularly go and expect from the core PCE deflator. So I don't think it's going to be that big market moving event, especially that inflation prints are still important, but they've just gone down a notch relative to activity indicators at this point in time. So to me, I'm not really expecting anything really substantial out of this. As long as we get that continued disinflation story, it'll help feed the narrative that rate cuts are coming through. We don't want it to be too cold, because then it starts implying that demand is getting very weak at the moment. So I don't think it's actually going to be that much of a big deal. More so, I'm much more interested in what happens when it comes to income and spending data, because that's activity. So you've got the spending data is actual activity, what's being consumed by households, and income, the fuel to go and power that spending. So to me, they could be almost equally as important, if not a little bit more, than the actual core PC deflator. Apart from that, There's not a lot out there at the moment. The final read of the Uni of Michigan Consumer Sentiment Survey, it's going to be very, very noisy. And unfortunately, because of the week, the way it's structured, there's not a lot that we can go and new information, which means that to me, a lot of these kind of secondary indicators that we're going to receive are probably going to get far more attention than what they actually desire and need. So it points to an environment where things will be choppy. It points to an environment where you might not go and get trends. So keep that in mind over the next week and a half or so ahead of the payrolls report Friday week, because realistically, in my book, that along with the two ISM manufacturing and services PMIs that will come out at the start of the month are far more important than anything that I've discussed there. I did mention that there's a 2-year note auction. Keep a close eye on that because we know that yields have come back quite a while. And I'm not so much concerned about demand for treasuries at the front end of the curve, much more driven by what happens when it comes to Fed rate expectations and the like. To me, the concern is when you start talking about bond auctions further out the curve, where you've got risk premium that has to be going and priced in, and they have moved quite a fair distance down. And whether there be still demand for treasuries further out the curve is yet to be seen. The last batch that we saw that came out on that front, certainly demand was looking pretty weak. So that's something to keep a close eye on, considering we've got a 7-year note auction as well that will arrive later in the week. Let's have a quick look at some of the things that more broadly on a global scale. This is the G20. I'm just going to go and make this really quick here. So this here is all the key events to go and keep a close eye on over the course of the next week or so. And you can see here, no disrespect to TradingView who put this calendar together, the monthly CPI indicator for those of us here in Australia gets a lot of attention. This one's going to be really, really, really lopsided when it comes to goods prices, not so much services prices. And unfortunately, what we saw in the quarterly CPI that was released last month contained very, very different messaging to what we'd seen in the monthly indicator. So to me, it's really lessened in its importance. If we see a big market reaction based off what this indicator, my tendency would be to go and fade it because it's just not giving you the proper signal. We know that the RBA is leaning either to holding rates or hiking at this point in time. But we're just not going to go and get a true signal out of that. There's only, I think, a couple of categories in the services side that we'll get prices for. So to me, it's not going to be that important. There's going to be some inflation data out of Europe. Again, always has the ability to go and surprise, but it doesn't surprise often. And to me, that's one of those things where it could go and generate a big market move, but 9 times out of 10, 19 times out of 20, it often comes in line with the expectations. So again, I'm not really that excited about what potentially could come through from there. Yes, keep an eye on it, but to me, it's not going to be one of those really, really key ones. The Bank of Canada, of course, is really, really tuned to the middle of the rate cutting cycle right now, and we know that unemployment, the labour market's much softer there than what we're seeing in other developed economies. So this GDP report could potentially be pretty important. And then next Saturday as well, we start getting the PMIs from China. Used to be big market movers, but not so much anymore. Really quickly, I just want to go and have a quick touch upon this whole notion about the BLS and the payrolls division. They got a lot of headlines yesterday. So 818,000 fewer payrolls to March this year in the preceding 12 months than what was previously reported. Lots of attention. And I don't want to dismiss the importance of that we're now looking at a far slower pace of hiring coming through. But a lot of it was just modeled. And I really want to emphasize that the payroll support has been increasingly flaky for a long period of time, not giving you a really true signal on what's been happening in the labor market. And when it comes to the Fed and what its reaction function is going to be, it's not going to be driven by continued strength in payrolls or what's going on with payrolls. It's going to be driven by a whole gambit of labor market indicators, especially things like the unemployment rate, which has all this information combined. It takes the participation rate, it takes the level of reported employment, and it gives you a much cleaner read as to what's going on in the broader economy. So in terms of how do I see it right now? Well, I don't know, like anyone else, whether we're on the cusp of a hard landing in the United States. What I do know is that every single time central banks, the Fed especially, aim to go and start an easing cycle. They want to go for a soft landing. But things like the 2s 10s curve, which gets a lot of attention at the moment, you can see here, it actually came very, very close to disinverting. It actually did very briefly at one point. If you go back over time, the 2s 10 curve, when you see the rate really start to go and jackknife into positive territory, so 10-year yields much higher than 2-year yields, that's a sign that we often see at the start of a pretty deep recession or a downturn that you should be considered about. You wouldn't be able to describe it as a soft economic landing. The other thing as well that is getting not enough attention, but to me it's a really important indicator as to what's going on in the US labor market, and it's the U6, the underutilization rate in the United States. So basically this includes all unemployed American workers, and it also includes those, I can't do it for an hour time frame, let's go and do it for monthly. It includes workers that basically have, they would like to go and work more hours, they'd like to work full time, they work part time for economic reasons. So there's not enough work to go around. And excluding this big spike, which is around the pandemic, I just want to go and have a look at the similarities, because to me, it gives me a real sense as to this time is not different. And this is one of the warning signals that I'm looking at right now. And you can see here, prior cycles. This is around the tech wreck and September 11. What happened initially was that it bumped around the bottom, this underutilization rate. Then all of a sudden, it moved higher quite smartly, and then boom, up it went. Again, into the other GFC. Again, bumping along the bottom. Then all of a sudden, started to go and move higher. Now, I hate to say it, but when you look at what's going on right here, bumping along the bottom, and then we've just had this big tick higher. And to me, that's a warning sign. So is the Fed behind the curve? Well, I don't know the answer to that just yet, but it's something to go and keep a close eye on. So when the payrolls report comes out in 2 Fridays' time, whilst everyone's scrambling to go and keep a close eye on what's going on when it comes to the payrolls figure, which we know is totally unreliable, and look at the unemployment rate and look at the U6 rate, the underutilization rate, because that's going to give you a much better indication. If we see this start to really jackknife higher, things are in trouble, and the Fed will probably have to start going and cutting really aggressively. With that, let's get to some charts, eh? I know that a lot of you are hanging out for that, so let's go and start off with some of the daily stuff. And yeah, just wanted to go and look at potentially what's been going on with the US dollar. We saw a big bearish breakout during the week, and I was surprised at how easily it actually went and took place, but momentum can be a very funny thing. So this is the DXY, the daily chart. It's not a readily traded instrument, so you've got to be careful about interpreting the signals. But right now, we're seeing this breakout here, and I'll discuss it more on the weekly chart. But this bullish engulfing that came on Thursday, following that semi pushback against the very dovish pricing from the Fed members that spoke. So to me, that's just one of those warning signals that potentially we're looking at a turning point. Unfortunately, it's before the biggest event that we've seen in quite a while with Powell's speech. So it's difficult to go and really trust the price action. And today we're seeing a big move in the yen as well, which is seeing that reversal from yesterday, partly reversed again right now. On the yen, we might as well have a quick chat about that as well. Governor Ueda is on the wires right now. He's addressing the Diet. Hopefully I pronounced that correctly in the Japanese parliament. And yeah, for all the carnage that we saw in markets that took place a couple of Mondays ago, the unwind of the carry trade certainly has not gone and seemingly deterred his very hawkish tone that we've heard over recent events. So yeah, not really throwing down well, he's basically saying that they're still very much at the view that if they still see the need to go and hike rates, because even on their estimates of where neutral is, so where it won't go and add or detract from inflation or change unemployment, right now he says that they're still below the bottom of that range. So pretty hawkish commentary. I'm not surprised to go and see the yen's up about 0.5% at this point in time. But the BOJ relative to the Fed is a bit player, best supporting actor in this front, because it's not going to go, really, it's going to come down to the Fed. The Fed's going to spark a lot of the moves in dollar yen. Today in Asia, reaction, likely very thin volumes going through, because we're all hanging out to go and hear what Jerome Powell is going to say. So look, the broader picture here is that 3 pattern there, the 3 candle pattern, to me, looks like a morning star. So that is a reversal signal right now. But again, the price action so far today is not really backing that up at this point in time. Euro is another interesting one as well because it's part of the story when it comes to DXY, the biggest weighting. And you can see here a bearish engulfing candle taking place right here. And look at it at the moment. We're seeing a partial reversal of that, but very, very overbought on RSI. I wrote a yarn about this yesterday, a trade idea. And just basically going back over time, and since the GFC, whenever we'd seen RSI sitting above 74 where it was trading at the time, every single time outside the first year of the pandemic, we'd seen a reversal take place in euro. So to me, that's a pretty compelling argument right there. And unless we see power going to be very dovish tonight, there's every chance we might see an extension of that move. I will have a look at, Stephen, I will have a look at dollar yen as well on the weekly chart. Let's go to the weekly charts right now because from a signaling perspective, I love that what you go and get. Much more cleaner and much more easy for me to understand. Hopefully the way I explain it as well will be easy as well. You can see here, this uptrend broken and this horizontal support went through like a hot knife through butter, which should be concerning for dollar bulls. But what we've seen down here around about just below 101, take a look back. So we had this one episode last year, but have a look at since then in other times around that. Below 101 or just above it, DXY has bounced. So to me, that's giving me a signal that potentially we've seen this bearish breakout, but either we start to go and sideways rage train or potentially maybe we're already in the process of an early bounce back. But I'm not ready to go and ride off the US dollar right yet, just yet. I think that there's still too much dovish priced in when it comes to the US Fed funds curve. So to me, either sideways or maybe even higher. I'm not at this point in time willing to go and bet against the buck unless we were to go and see this zone really broken and then potentially a test of this 99.6 where we saw back in the lows of June of 2023. On Aussie US, yeah, it's looking all right, the Aussie. One thing I would go and just note here, you can see that we haven't seen the end of the weekly candle here, so it's difficult to go and get a really strong reading at this point in time. But if we were to go and see, say maybe the close come down to about here, the candle would present a pretty compelling case that maybe we've run a little bit too hard, too fast, and that would draw a pullback. So keep a close eye on that one into the close on Friday and then what happens on Monday as well. But right now, Aussie, it's certainly been a change. But if you look more broadly, we've got a downtrend, lower high, lower high, lower high, lower high. Until proven otherwise, it's still a sell and rallies play. Is that moment right now or potentially? Keep a close eye on that candle. Can I indulge myself and have a look at the Kiwi? I'm not a Kiwi, by the way, but I do like the idea of how it trades. And it's right now, when you talk about an important weekly close, it's incredibly important because if you go and zoom out on the weekly scale, you can see where this downtrend is coming from. So this is the other high back in early 2021. So this is the pandemic high. And you can see here, knocked back, knocked back, knocked back, knocked back. And then right now, it's trading. So around about 61.5 is where that potential level is here. So this is going to be a really important close for the Kiwi and maybe even the Aussie Kiwi cross if you like to go and partake in that. If we manage to go and close above that 61.50, then maybe go and get a little bit more of a foothold over the next week, 62.20. And then of course, we'll start to go and look at this pretty much a death zone around about 63.80 on the charts. But at the moment, the Kiwi is looking surprisingly good. And it just proves that all the naysayers and all the doomsayers who are talking about how the Kiwi was going to go down the gutter if the RBNZ cut rates before the Fed, well, they've been proven wrong right now. So look at some of the, actually we'll look very quickly at dollar yen, see if there's anything different from the, you can see here at this point in time, we've got a bearish engulfing weekly candle. And importantly, it hasn't managed to go and reclaim that January 2023 uptrend at this point in time. So maybe your waiters are hawkish tone today, no real change from Powell. Maybe that might go and give us a signal that we could potentially go and revisit the lows that we saw a couple of Mondays ago. But at this point in time, yeah, it's still too early. We need to go and see how that candle will close. But at this point, yeah, it's not looking overly convincing if you're a dollar yen bull. Let's go straight to what's going on when it comes to SPY in Australia. Excuse my highlighting skills here, they're pretty rubbish, but I thought I was going to go and get the point across. Now, at the moment, we're down for the session, we're still up for the week, but just have a look at where those red dots are on your on the chart there. So anywhere towards sort of 8,000 and just above on ASX 200 SPY futures. You can see here, it's really struggled. We might be on track for our highest weekly close on all time, but realistically, the price action around this level is not crash hot. So to me, yeah, it's one of those things where the range looks much more set. Look here around about 7,500. The last few times it's been down there, it's been bid at that particular level and offered around about 8,000. Until proven otherwise, that's your range right there. To go and get back up towards those record highs that we saw earlier this year is going to take a lot, because if you look at the valuations in the banking sector in particular, you go and look at what's going on with the iron ore price and some of our big iron ore miners. It's going to take a big turnaround iron ore sentiment as well to likely go and get it from a fundamental perspective. So to me, unless we see either the RBA really capitulate and go and start talking about cutting rates, which could go and lead to some PE expansion or the like, that's your range right there. Let's have a look at some of the US markets very quickly here. Yeah, E-minis, S&P 500 futures looking pretty decent. Even though we're seeing a bit of a reversal over the past couple of days, you can see here, morning star pattern bouncing after going and breaking this horizontal support level, will snap straight back, big bounce, and then we managed to go and reclaim this former uptrend. So as long as this candle doesn't go and break that below here, to me, there's every chance we might go and have a retest of the record highs. There's not a lot at the moment to go and suggest that there's going to be anything other than the potential that, as long as this is, it's important that we see this uptrend hold at the moment. That would go and give the sense that maybe a resumption of the uptrend is taking place. Whereas if we're going close below, well, then potentially we start dribbling lower. The NASDAQ will also play a pretty key role as to what happens with the S&P 500 as well. And whilst similar message here, a morning star on the other three candles before this week, I don't like to look at this candle right here. It's been knocked back, and you can see at this point in time, there's maybe a little bit of trepidation in the market because we have NVIDIA with earnings coming out later on next week. It's going to be after market close on Wednesday. And whilst we know that NVIDIA has got a very strong track record for beating expectations and really getting the markets excited about that AI narrative, how long can that go on for? It's supplying all the AI chips and obviously the technology that a lot of these tech companies are using to go and get excited about AI and what potentially could go and do for them down the line. But it's going to be one of those litmus tests for the market, and potentially it could be as important as anything that we see next week in NVIDIA. So just at the moment, we've seen NASDAQ futures, NASDAQ 100 futures never managed to go and break convincingly below its uptrend. So right now, it still looks okay for me. But realistically, keep a close eye on this candle, how it finishes up this week. If it goes and pops back above, that's a much more positive sign from a technical perspective for me. On that, let's have a quick look. I know that some people would suggest that NVIDIA is not really driven by anything to do with technicals or fundamentals, but let's go and have a look anyway. Well, maybe it is. You can see here, symmetrical triangle at the moment, and you can see knocked back and then attempted to go and break earlier this week. And then you can see here. So let's have a see how this weekly candle closes here. But yeah, a bearish pin or something on those lines is certainly a reversal pattern that you'll be keeping a pretty close eye out ahead of that earnings release. Looking at RSI 14 as well, the downtrend in bearish momentum is still in place. It hasn't been broken. So a lot of this move, yeah, maybe we're getting a little bit ahead of ourselves in the snapback that's occurred. If we were to go and potentially see a pullback, but 106.60 is a level where it's done a lot of work on the side, and it's traded through. You can see around here, but very important when it comes to a weekly close here. Bounced off it, rejected, bounced. So to me, that's one level to look at. And then of course, 97.42 is another level, the former record high that we've seen. So yeah, NVIDIA is going to be a pretty important event, you'd imagine, coming through over the next week or so. Look, we have gone over time, but look, I'm sitting here and have a swig of water and keep going and ask a couple of questions. Whilst I'm going to start setting that up for that, just a reminder that anything that I go and say is general advice in nature here, and anyone who chooses to participate in the Q&A section, you're doing it at your own free will, and I'm certainly not looking at any personal information to go and make these calls. This is just purely my own assessment. I had a question about Aussie yen. Let's go and have a quick look at the daily. I actually wrote about it earlier this week, and yeah, it's from a technical perspective, it doesn't look crash hot. It's not pulled back by any meaningful margin at the moment. But you can see here, this is a former uptrend that goes back a long way. Actually, I think it goes back to the pandemic lows. And it broke back through there, and then it really hasn't able to go and kick on with the move. And the 200-day moving average just above might explain that, because if you look back over time with Aussie yen, the times that you've gone and seen this particular pair interact with it, it's been really highly respected. Often tested, doesn't always go through. So that might explain it. But at this point in time, yeah, it's giving me a bit of a mixed signal. It doesn't look convincing at this point in time. And maybe, just maybe, we go and see, the path of least resistance being lower in the near term. As for whether now is the right time to go and buy Aussie yen, well, I don't know what the answer is. I don't know how much you're going to go spend on that. All I can say from a personal fundamental perspective, when I was in Japan back in about a decade or so ago, Aussie yen was trading about where it is right now. And I stayed in Tokyo, I went to the ski fields and did a whole bunch of stuff. And I can tell you, I lived like a king. So if that's something to go and put in the back of the memory bank, well, 100 yen to the Aussie is not a bad level to be going. And if you want to go and live it up, of course, there's always room for upside, but to go and get back towards these kind of levels up here, it's going to require a big shift in the US interest rate outlook and for risk to go and hold up entirely. Now, I'm sorry, I just don't see that happening anymore. This was a really unusual circumstance, this particular leg higher. And to go and get back there again, I think it would take something pretty monumental to go and change. So Aussie yen, look, it's at the moment, it looks a little bit toppy, not really convincing the past couple of weeks, but certainly not giving me any really alarm bells for a major plunge coming in the not too distant future. Another question that's being posed as to whether to go and stick with quality or where you want to be invested. Now, put the disclaimer that I'm not a pure equities guy by any stretch of the imagination, but we're at the end, we're late economic cycle right now. And so during periods like that, personally, I don't think you'd really want to be owning junky types of assets. You want to be owning things that have stood the test of time in other cycles. So to me, that's something to go and keep a close eye there. Oh, the chart, hang on. Thank you for letting me know. So there we go. You can see there that, not looking very convincing at this point in time when Aussie yen. When it comes to, where we are in the cycle, you want to own things that are really high beta risk assets, high beta to like the broader markets at the expansion phase of the economic cycle. And right now, look, it feels late cycle. So to me, you want to be invested in things that have stood the test of time. That's my personal view. There's always going to be the ability to go and have alternate views or different circumstances and the like. But at this point in time, it's difficult to go and see anything where you really want to be like YOLOing into anything that's uber risky at this point in time, especially like on the premise that there's going to be rate cuts because they're already priced in. Coking coal. Liam, thanks for the question. I'm not a coking coal expert. Met coal is something that I've written a little bit about, but more so the iron ore space. But when it comes to steel prices and steel markets in China in particular, the world's largest producer, clearly margin pressures are really intense at the moment. and demand for steel product in China is looking pretty soft at this point in time, and it's leading to a lot of Chinese steel mills looking to go and export overseas, which is in itself causing some pretty problematic scenarios from a geopolitical and a trade perspective as well. We've seen a bounce in iron ore that went and took place over the past couple of days, but it was about a story about how there's going to be some more support measures coming through to try and clear excess inventories in the China residential property sector. Look, maybe it will work, but I've seen so many of those similar stories that come out, and it always, funnily enough, always seems to be after we've seen a big move lower in steel and its input prices. But it's already fading the iron ore price. And I can see here, coke and coal, I know there was an accident in China that took place earlier this week that may have gone and shuttered demand, but I can see here in Dalian, the most traded coke and coal futures off nearly 5% today. So from a fundamental perspective, you need to go and get really excited about China's steel demand and steel mill margins to get excited about this lift in input prices like coke and coal and also the likes of iron ore and coke and the like. So yeah, not really answering the question specifically, but certainly from just a broad top-down perspective, yeah, you need to get really excited about construction activity in China first and foremost, and right now that's certainly a little bit premature in my opinion. Do I think gold has topped? Over depends on the time frame that you're looking for, but realistically at this point, gold has managed to hold up incredibly well in an environment where real yields, nominal yields, US dollar strength, and even just the smallest sign that we've seen the US dollar start to go and roll over, and just a modest pullback in US yields, and we've already seen the gold price go and hit record highs. In the ultra near term, sure, maybe we have gone and seen a near term peak. If you go and look at what's been going on in gold, there was a topping pattern. You can see here, that's right now, we go zoom in a little bit. There was an evening start pattern there and a decent reversal. We can see here 2483 is a level I wrote about today. Is a level you can go and potentially build trade ideas around. But are we going to see like a meaningful pullback in gold if we see, and unless the environment's very strong US dollar or big rise in bond yields again? Yeah, I'm doubtful. I think that the path of least resistance, and at least over the sort of medium to longer term for gold, is higher, and that's not just in US dollar terms, but in a variety of different currencies as well. Well, we've almost gone double over time frame, so unless I can see anything else come through, I just want to go and thank you for your time today, and yeah, I hope you have a fantastic weekend and the like. Unfortunately, apart from NVIDIA's earnings report, just to go and recap, there's not a lot that you can go and hang your hat on next week. So I expect markets to be pretty choppy, and I expect there's going to be a lot of overreaction to things that markets probably shouldn't go and overreact to. So keep that in mind when you're trading, and depending on what your timeframes are and the like, it's going to be a real day trading market. It has that sense next week. Unfortunately, when it comes to what's going to be like one of those key macro drivers, it's going to be probably the Friday after with that non-farm payrolls report and the ISM services and manufacturing PMIs that will come out earlier that week. So in the interim, yeah, let's see what NVIDIA has to install for us, and then go from there.